you can compare equity funds versus debt funds, but you have to also understand that they're two different animals. Hello everyone, and welcome to our channel, The Mutual Fund Guys, where we talk everything about mutual funds. My name is Samir Gilani, and on the other side of your screen is Mahesh Bhagwat. Mahesh and I are partners at a company called AMS Investments. AMS Investments is a mutual fund distributor based out of Mumbai with an office in Dubai. We are managing portfolios for 100 plus clients in mutual funds. Having said that, let's dive into today's topic. Last video, we spoke about the different categories of equity mutual funds, and we were discussing the different categories of equity mutual funds. Today, the topic of discussion is going to be debt mutual funds, and we're going to talk about the different categories, but the debt mutual fund category is quite vast. So in order to cover that in one episode will be impossible. And we don't wish to cover that in subsequent videos as well because it's quite vast. But we want to sort of help viewers understand the basic theme behind debt funds and why is it important, how is it different, especially from equity mutual funds. So let me walk you through the difference between a equity mutual fund and a debt mutual fund, and specifically the difference between equity and debt. As many of you know, equity is essentially when you buy an equity or you buy a shares in a stock, you're essentially buying a small percentage of ownership in that company. So let's say if you buy 100 shares in Reliance, because Reliance is a very large company, 100 shares, gives you a tiny little ownership in the company. Because you have the ownership in the company, you get all the benefits of that ownership, which includes company is growing well. Because you own the shares of the company, the share price also moves up. Okay, you get dividends from the company as in when it makes profits. So everything that Mr. Mukesh Ambani would benefit of owning the Reliance stock, you also get the same benefit, obviously in a much smaller proportion. So that is essentially what equity investing is. You're investing in the company, you're a part owner of the company, okay, and you derive all the benefits being invested in the company. In a sense, there is no limit to the amount of money one can make when you're investing in equity, okay, because there is no stopping of a company reaching newer heights. Okay, that's why equity investing is a large amount of people generate their wealth by investing into companies. Now, debt is completely different from equity. Debt is essentially when you are actually giving your money to a company or the government of India as a loan, and for the loan that you give to them, they provide you an interest. Okay, essentially, when you put your money in a bank, let's say you have a bank account in HDFC and you have lent money, you've put money into a fixed deposit. Essentially, you have given money to HDFC Bank. HDFC Bank then pays you an interest for the money that they've been using. So debt is similar to that. You essentially are giving money to a company or to the government, okay, and for that money, you're being compensated through an interest payment. It's very different from owning shares of a company because, like I said, shares of a company, you are participating in the growth of the company. When you give debt to a company, you are not really participating in the growth of the company. You are essentially getting a set payout in terms of interest, and that is what you are getting as a compensation. So it's very important for us to differentiate these two categories. Equity category is very different from debt. So having said that, Mahesh, maybe we can, now that the viewers know the difference between these two categories, maybe we can talk about debt as a category of mutual funds. Like, how is it different and what are the different categories in it?
In the debt category of mutual funds, to understand them, we have to look in terms of two things. One is what kind of maturity of papers do these mutual funds invest in. So when I say maturities, what it means is that, let's say the mutual fund buys a government bond, which has another 6 months to mature. Then the maturity of the government bond, the paper that the mutual fund holds will be 6 months, right? I mean, that's right. At the end of it, it will mature. When we look at debt funds, we have to think in two terms. One is, what is the kind of maturity of paper that mutual fund owns? And the second thing we have to look at is, what is the kind of paper that the debt mutual fund owns? So there can be two types, right? One is the mutual fund owns papers which are corporate bonds, which means that what the mutual fund has bought is the loans that corporate bonds have given. So this is a corporate bond mutual fund, right? And
Right.
two, it could be investing in government papers. So it's a
Okay.
government bond mutual funds. So these are the two types of papers that these mutual funds can own. And then we have in each of this the different maturities that they can own. So approximately, let us say, up to 2 years would be called short maturity mutual funds, right? So there could be various types within it, various categories within it. We'll not get into the details. There could be overnight funds, liquid funds, money
Short
market
duration,
funds,
basically.
but all of that would be in this category called
Hmm.
the short duration mutual funds, right? Then
Right.
there is something called the medium duration mutual funds, in which between 2 to 5 years, 6 years would be the kind of papers that those mutual funds could own. So it could be in corporate bonds or it could be in government bonds, but the medium duration mutual funds by definition would be around this kind of maturity between 2 and 6 years. And then there
Right.
is the long duration mutual funds. So in that long duration mutual fund, again, it could be corporate bond or government bonds that the mutual fund owns, but the long duration mutual funds would have typically papers which mature between 6 to 10 years or
Right.
so around that level, right? So basically debt mutual funds are a vast category. So if we keep naming them, there'll be like 15-20 categories in debt mutual funds.
Yes.
But
Yeah.
to give a flavor of what it is all about, we say that you have a set of debt mutual funds which are in the short term category, which is 0 to 2 years. Then there would be another set of mutual funds which would be in the medium term category, which would be 2 to 6 years or so. And then there will be another set of mutual funds which would be in the long term category, so between 6 to 10 years or more. This is how the debt mutual funds are categorized. And each of those categories could be useful for a certain kind of investor. Somebody who wants to take very little risk would go for the short duration mutual fund because there's hardly any risk of default in those funds, let us say, or in the papers that those mutual fund holds.
Right.
Whereas there could be people who would say, I want a little more higher interest and I'm willing to take a little more risk. So they would be probably going for medium term corporate bond funds or medium term government bond funds. And then people who could take higher risks and then they would go for a longer duration bond fund. So so it caters to everybody's requirements, but these are the broad categories. So I mean, if people look, there'll be far more, but these are the broad categories.
And I think generally speaking, Mahesh, the category of debt funds across the board, whether short, medium, or long-term duration, essentially, I think, given the situation of the interest rates in our country at that point in time, debt funds usually have given anywhere between 6 to 8% returns per year before tax. Okay, this is a general idea. It's not something that it will always be constant. It could change depending on what the inflation in the country is and what the interest rate of the country is at that point in time.
Correct.
But generally speaking, there are about 6 to 8%.
Yeah.
And this category is for those investors who like safety of capital, who are essentially not looking to participate in the upside of a company, but more looking to get a set interest coming out as from that fund, right? And it's very different from equity mutual funds because equity mutual funds, yes, they do give much higher returns than debt mutual funds on a long-term basis, but they also do carry different sorts of risk. I won't say they carry risk and debt funds carry no risk. Even debt funds carry risk.
Yes.
But equity mutual funds have a different kind of risk, whereas debt funds have a different kind of risk. And you have to be cognizant about the risk that you're getting in. But if you want to take a general statement, I would say that debt mutual funds are safer than equity mutual funds, but they're not always safe. And their returns are commensurate because they take lower risks, so the returns are also lower of 6 to 8%. I want to again clarify one important point that you can compare equity funds versus debt funds, but you have to also understand that they're two different animals, comparing apples to oranges in a sense, right? Because equity is a different relationship that you have, as an investor with a company. Whereas as a debt mutual fund, when you're investing in a debt mutual fund, you are actually having a different relationship with the corporate or with the government, right? You're giving them a loan in debt fund. In an equity fund, you're actually giving your equity so that they can use that equity to expand and do etc. whatever, right? It's very different categories, okay? But people usually, they mingle the returns, that they say they compare the returns, are different risk reward profiles. You should not do it, but people do it. So we don't want to get too much into the the different categories of mutual funds, what we will do is we will put a link down in a description on Excel sheet, which gives you the different categories of mutual funds. It's quite comprehensive. Every single fund, every single debt fund that you can possibly think of is in there, including the returns of the last 1, 2, 3, 5 years, and everything that you need to know is there. So if you're interested in knowing more about the different categories and the returns of these mutual funds, you please click on that Excel sheet, and you will get a better understanding of the funds. So thank you for watching, and we will come back with another episode on another category that is called hybrid funds to make it even more interesting. But that's slightly more interesting than debt funds. It gives you a flavor both of equity and debt. But we'll talk about that in the next episode. So thank you for watching.